Hello, everyone. How are you all doing? I'm doing great, and I'm running a little late, so I'm actually needing to get the website all come up for all of you, and then we can look at what's going on the tax side. So in the process of prepare for tax returns for folks, right? So there's some very common questions coming up, and I think if we just kind of go through what we know right now, and we might be able to come up with a really good practical tax strategies that you guys are looking for. And a lot of times if you search internet, you go best tax strategies, I think you get a bunch of feedbacks that really doesn't apply to you. And not like our firm, right? We are really a firm for small and a medium-sized business. And if your revenue is going from 1 million to 100 million, we call you our sweet spot, because that means if you come to our firm and we can help you really nicely because we're experienced with that. And who doesn't care about taxes, right? So, this would be really an important time for you to start thinking while you are preparing your tax returns, are you really using the tax strategies that is good for your business? Obviously, again, we're focusing on small businesses, right? So here, if you have a small business and this is the right time and a good time to share with me, and so we can learn it together. No responsibility disclaimer, you know that. And anything we talk about here, may not apply to you 100%. So what you want to do is to take it with a grain of salt, right? Just kind of measure it and know that's good for you. Or if you don't know whether this is good for you or not, you can always engage us to provide consulting service to you. And we are pretty efficient. We don't waste time. And when you come to us and we get down to the core and give you a to-do list, I literally finish my consultation sessions with my client and with a list of things they need to do and a list of things I do. So that way we get it done. So that's how we do business here. All right. So the first thing in this tax strategy, and it's probably sound really mundane, and it's like, what is that, Ying? And what do you mean by managing my tax bracket? But this is really actually important. I want to give you the next few slides so we can just get the concept in for you. And when your income level goes certain level, your tax rate is different. So when we are planning for taxes, if you want to be efficient with your taxes, the first thing you need to know that you sort of need to arrive where is your total income for the year, right? Because sometimes you sold a property, made a couple $1 million, and in your mind you knew, oh, my income is going to be a couple $1 million plus some more, and then you already know your total. So that total in the form of tax return is called adjusted gross income, AGI. That AGI is measured, the tax rate is calculated on the AGI. So it is important to know what your rough income is, and then you will know what rate you're going to use. So what I want to show you here is the federal income tax. We're talking about personal. The reason I talk about personal is because both partnership S corporation are all coming to personal. Am I right? So they're pass-through entity, and you file partnership return next week. And March 15 is due day, and you file that return, but that return gives you K1. That K1 get added to your total income, or subtracting your total income if you got a K1 negative. So with that, you know that in your mind, you need to know what's your income. Your K1 come in to add on, or your K1 comes in to subtract. Once you know that, our tax rate, income tax rate from 10% to 37%, and that is very different from the corporation rate, right? Our C Corp rate is what? It's 21%. So now let's look at this. Let's look at this table. And you remember I said the C Corp is 21%, but look at our 22% bracket. that is what? That's 41,000 a year income to 89,000. So let's say you do, so this is the strategy coming in. So let's say you have this big income out of your Schedule C. And if you leave it here, anything going above the 41,000 and the 89,000, this range, then you will start paying 24%. Is 24% bigger than 21%? The answer is yes. So that means, let's say if you have a W-2, that's 41, but your Schedule C is 100,000. Then in this case, maybe moving your Schedule C out so you can pay 22% of rate here on the personal, but the other one pays for 21% because they are different entity, they're different tax rate, right? I know a lot of people will tell you that, you know, and especially if people do not update their tax strategies on the regular basis, they will talk about double taxation, you know, oh, if you have the money in the corporation, it'll be double taxed. I will tell you that that would be such a simplified way to understand taxes. So it is not like that. It is definitely should not be a concern whether that is a double taxation or not, because as a small, medium business we are, and you don't need to worry about that. And what you really want to look at is your bottom line. If your bottom line is over $90,000 on your 1040, and the reality is that same dollar goes to a different kind of tax return, that's not going to increase the rate on taxes anymore. It stays on the 21%, but here we can go up to 37%. So understand the rate, understand your bracket. It is really going to help you. And then the next thing I want to mention to you is about the state tax bracket. Okay, and a lot of our clients are in Iowa, Minnesota, California, and Illinois. This is by far our largest client group. We actually have clients in every state, and maybe there's just 3 states we don't have any clients. We have clients in every state, but these couple of states are heavy for us. So we have a lot of clients here, and those are the Iowa, Minnesota, California, Illinois. They are all income tax state. You know, Florida, they don't tax you on the personal income tax, right? You know that. Nevada, taxes. So they are the one that they don't charge you after you file the federal tax return and 1040. You don't file state because the state don't have an income tax. Okay, but with some state with income tax, and you want to know your rate. For example, Illinois is a flat rate, and the Iowa, Minnesota, California is all graduated rate. So if you, let's say if you happen to be at a time to choose a 2-employer, and they both offer you the same amount of income, but one is in Nevada, the other one is in Iowa. You know, I am Iowan. I consider myself Iowan, and I certainly don't want people to move out of Iowa. It's such a great state. But if you got a job offer for $100,000 and one is in Nevada, one is in Iowa, and without looking at anything else, people will go to Nevada because they don't have to pay the 8% individual tax, right? So this is where the state bracket comes in. So when you plan your tax, folks, and when you plan your business, so the state do comes in, and you don't have to, you know, form the business in any certain state, and you want that to be catered for you. So these are the things I want to expand your thinking in terms of taxes. Rate is one thing, and the taxable or not taxable state is another thing. So make sure that the reason we talk about personal side of things is because your 1065, your 1120S, like your partnership and your S corporation, they are all what? They're all passed through to your 1040. You can't get away from paying 1040 taxes. All right. Now, the other big area for tax planning is this accounting basis. And so what is this?
what is this accounting? What is this, right? And you want to make sure that your accounting basis is making sense. So let me talk to you about this one. Some of, as an individual, and when we file our 1040, do you have a choice to say that, oh, my 1040 start from July to June, and I am not January to December? You don't have a choice, right? So that is what that means. So in some of the businesses, you can choose to not have it from January to December. You can choose your years to be a seasonal business. You have a different year. Why is that important? Let me just explain to you. Let's say you're running a construction company. I'm just using this example. And your constructing time only can be in the summer. So by October, you're wrapping up everything and you're done. So if you're wrapping up everything, you're getting your payment, everything is coming in December. And is that a good idea for you to close your year in December? And no, it is not a good idea, because all of the income coming in, you haven't even spent it yet. So you are gathering a large amount of income. Then right after that month, you start paying taxes, income tax. That doesn't give you a lot of room to deduct that income. So seasonal business has a reason to be not by January to December. So that is something I want you to know, that you have a flexibility in business to have that fiscal year instead of calendar year. Of course, accounting considerations is also including accounting method, right? So what is accounting method? Accounting method, a lot of times people think cash method, accrual method. Yes, and the mark to market is also accounting method. There's other accounting method, first in, first out. There's all kind of accounting method. So you want to know why people care about an accounting method, because the revenue will be presented differently. One accounting method could make you pay more taxes because you do it this way, you recognize more revenue. But the other accounting method could be reducing your revenue so you don't pay a lot of taxes. So accounting method is really something that you decide when you first file your company tax return. And otherwise, once you got accounting method nailed on the return, you say, well, I just suddenly decided I don't want this anymore. I want to change to accrual. Then you have to file an application for changing accounting method. That is not an easy application. Yes, that application is very involved. IRS wants to know what kind of result it's gonna have for my revenue generation with you changing accounting method. They want you to calculate that. You almost has to do a hypothetical calculation first when you don't change accounting method, then you calculate another one, you change accounting method, then what that is. So a lot of larger corporations, larger companies, they would have an accounting team there to do these type of calculation, to make these type of changes with IRS. But small business, small, medium-sized business from 1 million under 100 million, people like us, and we don't have to view that as such a burdensome process. We just want to make sure that when you start your business and you get your accounting method right. So briefly, I want to just cover on cash basis and accrual, because a lot of times people are confused with whether this is cash method or accrual method. So cash method accounting, basically, you can just think of is almost like your bank account. If the deposit came in, that's your income. If the check you wrote and cleared your bank account, that's your expense. That's why a lot of small businesses are going for cash method, because it is very straightforward. They can look at their bank statement, know that how much money they have left, right? But once you run your business on a multi-million-dollar basis, and you naturally goes into accrual, because some of the check that you wrote not cleared, and you want to account them as expense. Some of the income you build is in the receivable, and then you want to account that properly as accounting accrual method suggests. Then you will be paying taxes on the accrual, on the accrued revenue. But then IRS also allow you to deduct those allowance for account receivable, which means that maybe percentage of your receivable doesn't get collected. They allow you to deduct that right away in that same year. So accrual method has a way to handle the taxable income. Cash basis has another way to handle cash income, right? So those are the important things that you want to know when you have a business. See, right now, what we covered so far, we were talking about rate. We need to care about the rate, okay? You know the corporation rate is at 21%. You also know that your rate is from 10 to 37%. Then I leave that with you. And we also talked about the state. The state, their state don't have income tax. Their state has income tax. And no wonder a lot of retirees are moving out of Midwest and go to warm places that doesn't pay taxes, like Nevada, like Florida, right? A lot of people doing that. Well, Trump is in Florida. You think he's in Florida just because it's close to the sea? Or you think he's in Florida because it doesn't pay taxes? Of course it's latter, because he knows what to do. That's what he did for his business. That's why he only paid $700 some taxes all of these years he's doing business, right? So that is a consideration. Now, we also talked about this accounting method thing and the cash method and accrual method. And in there, we throw in that fiscal year concept for you. So you kind of know that, oh, yeah, if I'm running a novelty store, I sold all these Christmas ornaments in December, and then come to January the 1st, I already start tally them up, and man, I made so much money, but I didn't even pay the inventory yet. I'm cash method, then you're in trouble. Then you just pay more taxes, right? So those are the things that you need to know, you want to consider. This is what we call tax strategy. And that's what we do when we review businesses and we see all of these angles and we start to plan what is most efficient for this particular business. To have the best tax strategy, one of the important things is the structure. I had written several articles about the tax structures. I also have webinars on the YouTube channel. If you search for 3D tax structure, number 3 and the D as dimension, you search for that, you'll find videos that I have. It really explains the structure. And this way I explain is really fit for our small, medium-sized business. I know if it is Amazon or Google's and people like that coming in to look at my webinar, they will be like, oh, really? You are doing that? Because their level of complexity is totally different from what we are dealing with, okay? But I want my folks who follows me and to get this under your skin, is part of you. You've got to make sure that this is a nature of your thinking when you get into a business, because that will really help you to reduce your taxes. We have people who are running business under Schedule C, and with $6 million revenue and running in Schedule C, and it is inefficient. Yes, you pay more taxes, and we don't mind. IRS does not mind for anybody to pay more taxes. And if you're willing to pay more taxes, we also don't mind. You can pay taxes. But if you are here listening to me because you want to be efficient, then that is not a way to go. Okay, so there are five established structures, very well known to the small business world. Okay, sole proprietorship, of course, and LLC and LLP, those are limited liability company. Okay, A lot of them, LLC and LP, without doing an election, you will be filing them as a 1065, right? Then S corporation is 1120 as filing. C corporation is 1120 filing. I'm sorry. Not for profit. So not for profit is actually a special status for any of the companies above. So let's say you formed S corporation or you formed the C corporation, but you decided the corporation is more of a nonprofit in nature, right? So you would go to IRS to apply for the status. How do you apply? And you apply for what we call exemption for income tax. That's a form 1023. So that nonprofit, there are people running business and turn that business into nonprofit. Once it is nonprofit, it is nonprofit. So I don't want you to think that, I'm creating a personal legacy. I'm going to pass on my business to my son, and but my business is nonprofit. That doesn't exist, right? Nonprofit is public owned entity. Basically, it's the board of the director and your stakeholder would in charge of that nonprofit. Unlike C Corp, S Corp, LLC, and sole proprietorship, they are privately owned entities. So there is a chart I have been using in several of my other webinars, and I brought it here for you to look at. This really speaks about these structures. So let's look at the 1040. If you see the boxes in the 1040, there is a Schedule C, there's an LLC, right? So what I am saying here to you is, if you are sole proprietor, or if you are a single member LLC, it is all belongs to your 1040. So your tax rate is from 10% to 27%. And your state taxes, it is going to be graduated higher, depends on your income, okay? And if you don't have a state taxes, you're in Nevada, then you just have this federal tax. So that's what that 1040 box is telling you. And you see that little dotted line from LLC goes to S Corp, C Corp, 1065. What I am saying there is that you can turn your LLC, single member LLC, into the following entities by making an election. Okay? And then look at the other one, S Corp. The S Corp was sending the K1 to LLC, okay? That would mean you can actually see how the money from S Corp you made went into your 1040. If you made a loss, it will reduce your income. If you made a gain, it will increase your income. Same thing with the multi-member LLC, it will pass on K1 to you. If you made more, you pay more taxes. If you made a loss, and you get a refund, right? The dotted line on the LLC says that you can elect the LLC to be S Corp or C Corp. The dotted line on S Corporation says that you can revert your S Corporation to be a C Corp. You see how all of these entities, they are not set in stone. They can change. They can move around. Of course, there is a rule. You cannot be changing entity type like changing baby diapers, right? So there is a rule to make sure that you don't do that too often. So there's a 5-year stay and a general rule to prevent you from changing them too often. Now, look at the C Corp in that chart. It's buried under the dotted line. What that means is it has no relationship with your 1040, with your personal tax return. Yes, C Corp doesn't really have relationship with your 1040. The only thing C Corp can impact your 1040 is when you issue W-2 on C Corp or when you issue dividend on C Corp. And the C Corp can be elected to be S Corp. So you got the dotted line going. Okay, nonprofit, look at nonprofit. The only thing the nonprofit can impact your 1040 is to say that if the nonprofit pays you a W-2, if you are working in the nonprofit paid you salary. So the structure tells you that it's flexible and it is interchangeable. With that, if you stuck at S corporation thinking, well, right now to be in here is not beneficial because we're making way too much money, and maybe C Corp is a consideration, then, it can be changed. You don't have to open up a brand new company. You just use your existing structure to make a new arrangement. So this is where this particular section, what we want to say to you is that the tax structure is one of the key components for your tax efficiency planning. And we talked about the other ones, but from the rate to the method, to the accounting method, now we arrive on tax structure, and those are the strategy. When we talk about tax strategies, this is one integral part of it. All right. Now I want to talk about another piece for the tax strategy. And it is often get ignored because people don't know. If you don't know, you don't know. If you miss the bus, it's not like you can go back to claim it. Some of those credit deductions, you can't go back, okay? So let's understand what's the difference between tax credits and the tax deductions. This is a really good example, okay? So let's say, and you have $10,000 tax deduction. On the other column is a $10,000 tax credit. So look at the first column. If it is $10,000 tax deduction, so you less the tax deduction out of your AGI. So your 100,000 total income minus 10,000, your taxable income is 90. If your rate is 25, then you pay, you calculate taxes 22,500, right? So your total tax bill is 22,500. So what about if you have 10,000 tax credit? So your AGI is 100,000. Your taxable income is 100,000. Your rate is 25%. So your calculated tax due is 25,000, but minus that 10,000 tax credit. Look at that, folks. Look at the bottom line. So if I have $10,000 tax deduction, I am like, hooray, and really good. But if someone say, no, that's a 10,000 tax credit, that is even better. Look, your tax bottom line is so much less than what you had from the other one, right? So now you're going to say, oh, I didn't know that. I did not know that. Okay. So our child, in the 1040, our child tax credit is a tax credit. Got it? So that is reversing your taxes. If you don't have tax to reverse, they give you that tax credit. So that's not a deduction. But what is deduction, folks? Standard deduction. Standard itemized deduction. That is a deduction. That is not a tax credit. Right? So now you kind of had the concept of the deduction and the credit. So now let's look at the business tax credit. Business tax credit are the amount that the company can subtract from the taxes they owe. Okay, what are they? The most popular one now is being used is R&D tax credit, work opportunity tax credit. You probably ask me, what is that? What is that? Generally speaking, R&D are research tax credit. Let's say if you are doing research activities and you spend salaries, you spend materials, then you can calculate that amount and that become your tax credit, folks. It is your expense, but become a tax credit. Work opportunity tax credit. That is when you hire people come out of welfare, okay? And that would give you work opportunity tax credit. Credit for employer paid tips. Restaurant owners, if you don't have that on your tax return as a tax credit, you really is doing something wrong. That is a tip credit. It's a huge amount. It is actually a great credit every restaurant owner should be getting. Of course, there is an employer provided childcare credit, solar incentives, their tax credit, okay? And what are the business deductions? Business deductions are kind of like the expenses, right? For example, your travel expense, your meal expense. And remember, we talked about this in other webinars. And in 2021, and the federal government had put out an amendment to the meals deduction, and they allow you to deduct 100% of restaurant meals for business. It used to be 50%, remember, folks? They made that change because they're trying to stimulate the restaurant businesses to come back up. So they are allowing 100% deduction. And of course, your regular, all of your salaries and your expenses, that's a business deduction. These are reducing your taxable income. Then, of course, one of the most important things I want to talk about here is that understand the regulation changes in taxes. And I want to here mention a couple of things really important. In 2021, when you do your business tax filing, and you want to be sure to give your tax preparer the PPP amount that you have gotten forgiven. And the PPP amount is not forgiven, it's sitting on your balance sheet as a liability. But as soon as it's forgiven, it actually can easily become your income if it is not accounted properly. And a lot of tax preparers, they're not accountant. If you give them the accounting record that is done wrong, and they will just add your PPP into income. But do you know that PPP is not your income? You don't pay tax on PPP, folks. You don't pay income tax on PPP amount. And you don't pay income tax on RRF, okay? And you don't pay taxes on some of the state grants. And the state grants is a little tricky, just because we work with so many states. Whenever we see state grants, we actually go to the state website to make sure that's not taxable. If there is no word about not taxable, then it is taxable, right? So those grants you are getting in 2021, and you want to be really careful to know that whether it need to pay taxes or not. Please do not assume people know. People don't. All right. And for S corporation, if you have an S corporation and you got a PPP forgiveness, folks, and your shareholder base is going to be changed and changed for better. If you don't account that properly, you lose out a good opportunity to save yourself taxes a big time. And why do I say that? I'll say this to you, give you more specific on what I was talking about. Let's say your PPP forgiveness is $10,000. In S corporation, that increases your shareholder basis. So let's say your shareholder basis was 0. Now I'm going to put that 10,000 in there. Okay, so you got a basis for 10,000. Let's say tomorrow you sold your company and you sold it for 10,000. Because I have that 10,000 basis in there for you, when you sell your S corporation, you pay 0 tax, 0 capital gain, because you have the basis and you sold exactly the amount the base has, right? But let's say you didn't do this right. So that wasn't added to your base. And you have a basis, what, 0? You sold your company for 10,000. So now tell me, what is your capital gain? 10,000. Yeah. Okay. So with that, I want to mention to you, these government grants are important to understand. You know, I plan to put out another webinar and on Tuesday, the coming Tuesday, to specifically address how government grants are treated on your tax return. I hope I can finish all of that research with my staff because we're really busy with tax time. So I didn't really want to tap into too much of our time to do research and preparation. If I'm ready for that, I will be talking about this because it is really important. And we have already seen mistakes. People brought in taxes for us to review. You know, we think is, you know, it's a 1 hour work, we're gonna review and then it will be done. Then it turned out to be have to redo this whole taxes because it's just not right. So with that, you want to make sure you work with your tax preparer patiently and know that they have a lot of stuff going on. And I am sympathetic to all of the people in my field because we have been hit really hard with so much work because all these regulatory applications, PPP, ERC, RRF, and all of them are coming through the CPA firms, small firms, people like us, right? And imagine those are works in addition to what we already have. So it is not easy, but looks like things start to getting better, right? You know, that's how I feel. I feel like things start to getting lightened up and people start to get used to what they were doing. And, you know, government are not as crazy as they were. So pandemic is sort of in the rear mirror right now. So hopefully things will just get better. But for you to make sure your tax return is filed properly, why in a hurry? Just file extension if your tax preparer is really busy and they don't have time to answer all of your questions. And file the extension, give it time. Because when you file extension for March 15, it will extend that return to September 15. And when you file extension for your 1040, you extend that due date to October 17, I believe, right? So then you have the whole summer to toss your fun and start working on taxes. I'm just kidding. Of course, you want summer to be fun, right? But you would have a lot of time and your tax preparer and your accountant would have a lot more time because we don't have to run for PPP, ERC, RF for you guys like we were doing last year this time. So hopefully, and that will give you a solid return and don't make mistake. If you do, it's just a lot of consequences when there is audit. Of course, you know, if you do everything right, you are not a fear of audit. Audit is okay. But the thing is, when you get into audit, you spend more time because the auditor needs to see what you say is true. So you've got to pull up every cell phone bills and you got to pull out all the receipts. So that is time consuming. I'm not saying that you're worried about audit. Nobody should be worried about audit. Audit is a normal procedure. It's government trying to assess how accurate outside of the government people are doing because, tax filing is more of voluntary and system. It is not policed by, to every taxpayer. They're just getting sample taxes to come out to audit, right? And IRS has special project. And 2 years ago, they had a project for 1065. And they will put together a group of taxpayers and they're all 1065. Then they will draw them and then audit them to see how accurate people are filing taxes. In our firm, we have one taxpayer who were sampled out of that project. And, she got through that 100%, no change. So, it just says that the government does that, but as long as you have all your ducks in a row, there's really nothing to worry. But just make sure your ducks are in the row and you're not losing your ducks, okay? They need to be lined up properly and they look cute and lovely before you meet with the auditor. So that was the talk about the regulation changes and stuff like that. And then I also want to bring you some other considerations in the tax strategy we're talking about. And I know my talk today is very, very top level, but for you to dive into individual one, that requires you to know the detail of your situation. So if you can memorize what we talked about today, we came through the rate, we came through state taxes, we came through accounting method, we came through fiscal year, calendar year differences, we went through tax structure, and then we tapped onto the new regulation, the new grants, the government grants, how we should account for that, okay? And we also now gonna touch on these couple of things. I will tell you that that is all. And there's no other ticket I can pull for you to tell you that, hey, there is another strategy you should know. These are all. If you hear me talking about this, you bring those into your tax preparers or people you trust to work on your taxes, and they will respond to you. They all know that. Maybe they just didn't summarize it up like I did for you. But the reason I do it for you is because I believe that as a business owner, you got to have that high level view. You cannot just know how to add 1 to 1, 1 plus 1 equal to 2. That is not enough. And you need to know things at a higher level, not a calculator, right? Business retirement plan. And this is something that I recently had a lot of talk with people. I am not licensed. I'm not licensed a financial planner, but I work with licensed financial planner on a daily basis because our client has revenues and they want to reduce taxes. I want to figure out a way to do it. So I use their product to do that. Okay. So I want to give you this concept. When you have profit in the business, and you need to start looking at retirement options for you, for your employees, and for your company. And then there is what we call the pyramid, like you can go for, and you build your retirement, then you build for the employee, and then on the top, you build for the company. So we call that the top one is a pension plan. And right in the middle is a profit sharing. And then on the bottom is 401k or retirement funds, whatever you do, okay? So you want to make sure that you tap into retirement maximum every year, because once you miss a year, it doesn't come back to you. It's not like you can catch up for the last 15 years. So you really want to make sure you maximized this year, okay? So that is where I call it business retirement plan. Not just for you, we're talking about you, then we're talking about employees, we're talking about the whole company at the top, right? If you work with us and I give you those plan, then if you have financial planners and you can go to do that, or we can introduce you to financial planners that who are maybe our clients. A lot of times we don't have any monetary dealings with referrals just because I don't believe in that. If we do monetary referral kind of arrangement, you can be sure that we only give you that one, the business will go for profit, right? Then we will be giving you someone, maybe they're not that great, maybe they're not a good fit. So in that referral process, we never get involved with the money. We just go with our heart, and we know that you're gonna fit with this one, we send you to that person. If we think you're gonna fit with another person, we'll send you to that person, even if that person is not our client. But a lot of times I know these people really well is because they are our clients. So I know how their business is going. And we have financial planners are so successful. They have a large company, and those are the people I know they're capable. If we can move you into those kind of company to be affiliated with successful people, you will be successful. Doing business is one thing, but getting your circles fixed, knowing who you go to is another thing. It's really important. Okay, to have a good CPA is definitely important. All right, and the personal retirement changes. So the retirement deferral amount is changes every year, right? So this year I think is 20,500 for anybody under 50. So you can defer that much money to your retirement plan. If you're over 50, it's 27,000. So those are the changes that you need to know. And of course, their charitable contribution is one big ticket for tax saving. That's why we were talking about nonprofit. You know, if there's no nonprofit fulfills your goal, and you would do charitable contribution to a nonprofit you formed. Yeah, why not? And I mean, when back in 2008, and I and two other business owners, we together established Immigrant Entrepreneur Summit. That is a nonprofit. That nonprofit has been running for now, what, 17 years, okay? And I started it, so our firm regularly contribute, financially support the nonprofit organization. And sure, you can say that, well, Ying, that is your tax strategy. And actually, I didn't really come from the tax strategy to do that. The reason I did that is because I see a lot of obstacles to the immigrant business owners in this country, because they're not so familiar with the culture. They're not familiar with the regulations. They don't know. If they don't know, they do wrong things. If they don't know, they do wrong things, the government go after them, and then they bankrupt, then they fail. And they worked so hard for so many years, and one audit came, they lose all their money. So with that, we want to have this education for business owners. It doesn't matter you're a college graduate or not. It doesn't matter you speak English or not. Well, of course, you have to speak English to understand what we're talking about. But it doesn't matter how bad your English is, as long as you come in and we actually give you that crash courses in that IES event to just teach real stuff, like how to apply for food license, you know, how to do liquor license. So things like that. And, you know, so charitable donation contribution is one big piece. You do save taxes. And of course, tax efficiency investing, where you can invest in those portfolios, the governmental portfolios where you don't pay taxes, right? Long-term capital gain is also another thing. Long-term capital gain, it did not raise the rate. Its maximum is 20%. So if you have something you hold long-term, and then you don't want to change it, don't do mark to market. Just leave that just the way it is, and so you can get the low rate, right? There's a lot of things, and when you buy and sell property, folks, always know, are you buying and selling for primary residence? If you do, you know that you have a $500,000 capital gain exemption there, right? Then are you buying, selling for your investment property? So where is your investment property? Is that in Nevada? If that is the case, maybe you should not be forming an Iowa company, right? So there are so many things you can consider. And I think in the end, if I want to give you one sentence, one statement saying that to help you to be tax efficient is to affiliate yourself and to educate yourself. Affiliate yourself with a CPA firm that you can trust, and educate yourself going for reliable sources. And I think our webinar is a reliable sources, even though we actually we have the disclaimer to protect, to make sure that we don't cause bodily injury to anybody. However, and every webinar we come up, it is being researched and studied by multiple staff in our firm. So we actually are wanting to make sure that our resources is coming from reliable source. So irs.gov is actually my library. And I know, I tell people that I don't know more than you do. I just check on irs.gov more than you do. That's really what that is. But you know, we all have our own profession. I don't want you to give up your restaurant to become a tax person just because I say you should search on irs.gov, but you can rely on us. And I want you to do what you're good at, and we will do what we're good at, and we help each other to grow. And in business, there's never a grow singular. You cannot grow your business just by yourself. Trust me, even if you think you did that, no. You probably relied on your spouse. You maybe even relied on your kids. You relied on your parents-in-law and the mother and the father. Who knows? You never can be successful just on your own. You relied on your employees. You relied on the people who come in to work for you for free because they want to help you, right? So those are the factors. We don't grow just singular by ourselves. And we can form this community and a community CPA community and to help each other to grow in business. All right. So the last slide I have is to tell you that where to find us. You can always email Catherine. She is our marketing manager here in our firm. She also manages one of our branch in Coralville, and very busy person, but you for sure will hear from her. And she helps me with my slides. And actually I rely on her a lot. And she, I sometimes call her librarian just because she does a lot of research as well. And we also have Dr. Hao in our team, and he is literally a professor. And so he does very good research for us. And so we rely on those experts to provide you with reliable information. All right, I conclude Saturday. Hey, don't forget to have fun on Sunday. And if my webinar overwhelms you, and you can go back to the YouTube, hear it again. And because until this is your knowledge, you never will be good with tax strategy. So just make it yours by getting it again and listen to our webinar again. All right, talk to you. Bye-bye.